Hello, everyone. Thanks for coming back from lunch so promptly. We're ready to get going now, and this is the third session, Theories of Digital Money, and it's chaired by Sam Hart from the Governance and Legal Theory think tank, Koala. Thanks, Sam.
Thank you. Welcome back, everyone. Okay, so we'll have 4 talks in this session. People are probably going to be trickling in from lunch, so we'll get started in just a sec. First, we have, first we have Jacky Mallett from, she's an assistant professor at Reykjavik University in the computer science department, where she teaches computer networks. And she was appointed to the supervisory board of directors of the Icelandic Central Bank by the Icelandic Pirate Party for 2 years running. She will be presenting her paper, Scaling Consensus in Monetary Systems. And do we have you, Jacky?
Yeah, I hope so.
Hello and welcome. Yeah, please, when you're ready.
Okay, it's always a bit unnerving doing these remote presentations. So I'm afraid I'm not able to be with you today because Iceland is having a little bit of a coronavirus outbreak. We're up to 50 people now, which is a bit unnerving, but not to worry. What I'm going to talk about is scaling in monetary systems and essentially extending what we know about scaling in any network-based, message-based system to 2 monetary systems of current interest. One obviously is Bitcoin and the cryptocurrencies, but the other, which is also interesting, is the existing monetary system, which is essentially represented by fractional reserve banking. And scaling is, I think, a reasonably well understood problem now in computer networking, but possibly not elsewhere. And it is something that we've really only developed a complete theory of in the last few years. Essentially, when we're looking at problems with scaling large-scale distributed applications, what we are looking at is a function of the system's topology. And it's possible to essentially map out different scaling regimes depending on what topology the system is actually using. We sort of go from left to right. We have strictly hierarchical systems, which are the sort of the old scale client-server applications, and they scale essentially as a function of the capacity of the servers. In the middle, we have full mesh applications, which are applications that simply have nodes that are fully connected to every other node, and they scale fairly badly in terms of the number of nodes they can accommodate, because essentially they are limited by the number of connections each node can handle. And then on the far right, we have the partial mesh applications, which Bitcoin is a representative of. And it was shown in 2000 that they scale as a function of the link capacity of every node, so the number of messages that each node can handle from the nodes that it's connected to, and the square root of the number of nodes in the application. And a little later on, the other observation that's been made about these scaling limits is that if and only if you can essentially restrict communication in the application to be as localized as possible. The name I have for this is the group of groups topology, where you essentially arrange communication in well-connected groups and then link the groups up. It's possible to show that this can scale fairly arbitrarily as a function of group size, provided you have this provision that there isn't too much long-distance communication going on, that basically the nodes are only communicating with other groups when they absolutely have to. Now, if we look at this just in terms of the mathematics, the red line happily beetling off to infinity in the middle of this graph is the full mesh, every node is communicating with every other node case, n squared essentially. And the other lines, the order L square root n's for the various values, they are essentially showing different scaling regimes depending on the link capacity that's being applied to the application. Now, the number of messages in any particular application that any node can handle in a sort of real-time instance can obviously vary hugely. And essentially, the bigger that you can make your value of L for your application, the better you can scale. So a large part of the story of the last 20 years is the peer-to-peer networks in particular, which are bound by this particular scaling limit, have been deployed, is that because of Moore's law, they've been taking advantage of considerably improved computer resources. And so L has been going up, they've been scaling better, and the limits on their scaling, which are still there, but not perhaps quite so apparent, haven't been given perhaps quite as much attention as they needed to be. And one of the ways this manifests is something that occurs on the left-hand side, which is quite interesting, but also somewhat deadly for developers. In any kind of small application, what happens is it doesn't really matter what topology you use, because the limits on the communication are essentially greater than the maximum amount of communication that the nodes present can apply. So there's this magic corner on the left called the lab, where essentially any topology works. And quite often applications only discover that these limits exist when they deploy to the real world, a lot more nodes are added to the network, and suddenly they start having congestion and scaling problems. Now, there's one other interesting thing about this, and it's particularly interesting in terms of monetary applications. Broadly speaking, there are two topologies that can scale completely arbitrarily in terms of the number of nodes they have. One is the hierarchical network, which has really bad information capacity, because one way to think about this is that it's essentially wasting a lot of capacity at the bottom where the clients don't talk to each other. Obviously, in computer networks, we tend to not worry about that because we engineer the servers to be extremely powerful computers with much higher message processing abilities than the clients anyway. But it is still a factor, especially as you start using just normal computers in the way that Bitcoin does. But what it does well is it provides consensus points, because all distributed systems essentially at some point run into the Fisher consensus problem, where because it's not possible to guarantee that asynchronously connected nodes can agree on any single bit values, what happens is you have to synchronize somehow. And the simplest way to synchronize is just to have a single node that acts as the consensus point. So hierarchical networks do this very well, and that's why they're used so frequently, but they have really bad scaling. The peer-to-peer networks and the organized peer-to-peer networks, group of groups, scale very well in terms of their information capacity. You can pump a lot of messages through them. They're also very robust to individual node failure, which is a highly desirable property. But in some sense, they exemplify the most difficult environment to provide consensus in, because there is no single synchronization point. And this can be good or bad. But if we're talking about monetary systems in particular, if there's one thing that people tend not to tolerate any uncertainty about, it's the value of their bank deposit or their wallet. So it's very important for these systems to guarantee consensus. And that essentially creates the sort of central contradiction that we battle with, which is you want the group of groups topology, you want the scaling, but you also want the guarantees that hierarchical networks provide in terms of consensus. And the genius of Bitcoin is essentially to provide a distributed way to provide that consensus. And it is, a really neat solution. The proof of work, essentially the way it operates is that in some sense, all the nodes in the Bitcoin network are racing each other to allow themselves to advertise as the single consensus point. So in that momentary instance, the Bitcoin network in some sense becomes hierarchical. but any node can provide that consensus guarantee. And once it's done that, it has to continue racing with all the others to do that. So the Bitcoin network manages to provide consensus in a very interesting way, but it doesn't have the scaling properties that it needs to admit its originator's original goals. Topologically speaking, the miners are connected to each other in a partial mesh, which reflects when it originates, which is the late 1990s, when peer-to-peer networks really start getting going. So what's happening in the network is that miners are relaying transactions to other miners so that each miner has either a full or a partial view of all the transactions that are currently taking part in the proof of work calculation. And there's a very elegant way for resolving that if two competing chains of transactions start being calculated. But fundamentally, the application itself is engaged in a full mesh exercise where all miners have to see all transactions. And so the higher level scaling property is in the L squared range, which is essentially the fundamental limit on Bitcoin scaling. Now, Bitcoin and all distributed applications tend to walk down this pathway when they run into these issues, has essentially tried to improve this. And the classic ways are always to try and improve L. So you can get a lot of mileage out of increasing the number of connections or the number of messages your application can process. So we've seen things like segregated witness, which increase the block size and remove some of the redundant information. Again, a very popular choice is to get rid of TCP and put UDP in, because UDP does provide faster transmission. This works well if you can guarantee that you've got a really good quality network underneath you, but you're also in some danger of discovering why TCP has some of the features it does in the first place. And again, you're still limited. You can improve your message rate, but you are going to bump into L at some point. And the other way, which is also quite interesting, is the emergence of sharding, where with mining pools, which we can sort of regard that as an option, you essentially create another little subnetwork, a little bit of a group, where only one or two nodes are relaying to the rest of the network, and you're sharing the information out underneath you. None of those things, though, solve the scaling problem. They really just postpone it. The more interesting recent attempts are with the Bitcoin Lightning Network. And this essentially is where it gets interesting, because the Bitcoin Lightning Network has a lot in common with the way the existing banking network tries to solve these problems. It's been described as bilateral netting, which is quite an accurate description. And essentially what it's doing is just taking some of the transactions completely off the Bitcoin block ledger, letting those be resolved without having to do any commits, and then just finalizing the final sort of agreed transaction as the sum of all the transactions underneath it. And as long as the parties trust each other, or some kind of cryptographic guarantee can be provided, that's a very good way of solving things. And I think what's more interesting is it actually does give the Bitcoin network or similar cryptocurrency applications a way to evolve into a more distributed group of groups type topology, because generally what we see with these very large scale networks, like the internet, the human brain, and for that matter, the banking system, is that they're not so much designed as they emerge. And as they emerge, it's because there are mechanisms within the application that allow them to find this group of groups distributed, efficient way of scaling, which at the end of the day requires the large-scale application to be able to localize its communication, which means there have to be mechanisms for it to do that. So if we look at fractional reserve banking system, which I have to confess have an evil sense of humor, I'm sorry. But as a network specialist, I sort of see this thing as confusing economists for the last 100 years. It does one thing very well, and this tends to get overlooked. It's a very good transport network for the monetary system. So evolving out of double entry bookkeeping, it manages to solve all these problems of consensus and scaling and provide guaranteed transmission of money across the world, even in the pre-digital period, in fact, in the medieval period. So with all its faults, and they are fairly considerable, this is still the technology that's in some sense allowed us to build an advanced technological society. And we should give it some respect for that, and also it's worth examining because of this. However, it does have some rather interesting monetary side effects if you let its lending get out of control, because it creates money at the same time. You will essentially destroy your entire economy due to hyperinflation. And you can also enter serious issues if you start having too large loan defaults, which I'll talk about in a second. How it works is quite interesting. Individual banks handle transactions locally. So if you're talking about transferring money between two customers at the same bank, that's just a direct connection at the bank. So that's not a particular scaling problem. And then when banks are transferring money between deposit accounts at different banks, what happens is they actually use physical cash as a slightly separate form of money to the deposit money that the customers are using to act as a semaphore. So they solve the consensus problem that is created when they're transferring money within the banking system by essentially using a baton to go between the banks and act as the consensus point of this account is moving money between the two banks. Now, that's occurring within a national banking system. Between national banking systems, it gets even more interesting because they're actually not transferring money at all. What happens is that selected banks essentially maintain accounts for each other in the different currency areas, and they use netting between those accounts. So one person withdraws money in Iceland, the Icelandic bank will give them that money and deduct that amount from the international bank wherever the customer is from. And that bank, if an Icelander's abroad, will do the same thing in their country. If there are unbalanced flows and one bank runs out of money, then essentially they will lend each other money to equalize. And what also happens then is that the foreign currency will adjust to the new loan flow. It's an open research question at the moment. We're hoping to simulate it later this year. But I have a strong suspicion that this may be one of the things that causes foreign currencies to adjust very, very quickly, which is actually something that's a little bit anomalous in terms of how the whole system reacts. So it's an interesting system. It does monetary transmission very well, and it scales very well. You can basically have, a fairly arbitrary number of banks in every country. It does, in some sense, use the group of groups topology. It's found that naturally. And it has, because of that, spread across the world over the last 400 or 500 years. Unfortunately, besides its hyperinflationary problems, which, to be fair about, shouldn't happen now because that is well understood and can be stopped with proper regulation, the problem that you can't get around is that it has terrible fault tolerance against loan defaults. And there's a famous quote about economics being the science of confusing stocks with flows, and if the economists want to be fair, they can actually blame the accountants for this. The problem essentially is that banks are governed by the expanded accounting equation. And if you look at that closely, you can essentially divide it into stocks on one side and flows on the other. The stocks are the assets, liabilities, and equity of the bank, which are the loans, the customer deposits, and the original capital, which includes money that is set aside for loss provision. And the flows, the thing that the bank has to worry about on a day-to-day basis, are the income in terms of the interest on its loans, the expenses in terms of the money it's paying out on savings accounts and possibly on loans that it's taken out, and any dividends that it can scratch up to pay to its stockholders. So do the math on that, the right-hand side of the equation, and it's quite interesting. Essentially, the math here is completely uncompromising. You can essentially look at it as simply how much money the bank can afford to lose on its loans in any given year. And this is a function on the spread between its interest rates and its expenses. And this turns out to be not very much. A back of the envelope calculation, which is what you're seeing here, shows it to be about 1% of its total capital, so the number of loans it's made. The industry figure is actually estimated to be somewhat lower, it's 0.75%. And this is for a well-run bank. If it's a bank that's already had issues, it may well have a lot of loans on its books that are in write-off or not performing. And I've seen, for example, Italian banks with 18% bad loans on their books, and those banks have a much lower amount that they can write off every year. So the Achilles heel of the banking system, and by extension our economy, is essentially this inability to absorb loan losses. So what happens in a credit crisis, and I'm afraid it's not too hard to predict that we'll probably be having one fairly soon, is that you get a cascade failure. The immediate problem that banks experience when they have higher losses is that because of the regulatory controls on lending, it restricts their ability to make new loans. New loans, in some sense, are what is pumping industry, but also there's a fair amount of companies out there that, in some sense, live off the difference between borrowing, using that money to create some value, and then repaying it, and then borrowing again. And those are the weak hands that tend to go first in any credit crisis. So unfortunately, what's happening at the moment is because of the supply chain interruptions from China, a lot of companies, and we're already seeing this here in Iceland just because of tourist impacts, are starting to announce losses because of this. And if you were paying attention to the financial press in the last week, then the central banks were starting to mutter that there's really not anything that they can do about this. And they're quite right, there's not. The banking system, has this huge Achilles heel with respect to losses. And there's not really a lot that, you can see that anyone can actually do about this. So we've arrived at this point in the 21st century. We have a very good monetary transmission system that scales very well, but it has highly undesirable fault tolerance attributes. And we have the cryptocurrencies, which actually have very good fault tolerance, but don't scale well. What I would say is a priority is that we should try to separate this money creation from lending in the banking system by going to cryptocurrencies. And this goes beyond, in some sense, incorporating cryptocurrencies in banking, which is something that people are looking at, obviously, because you can improve performance in the banking system just by providing a more digital way of transferring money around. But they have, online systems, real-time generation settlement systems that do that very well already. But that doesn't get away from this more fundamental problem of how do you handle what the banking system goes through if the economy stops paying back its loans. And there are other issues as well that we may be running into in terms of the whole system is in some sense predicated on continuously lending. So if for some reason the economy gets so efficient and so automated that you don't really need any new loans or not as many new loans as you had, then you're sort of looking somewhat inevitably at a monetary contraction, even though nothing has really gone wrong with the economy. And of course, the trouble with a monetary contraction fundamentally and why it's not allowed to happen is that it interferes with prices, and in particular, it interferes with the price of debt. But debt doesn't change its value. Even if the amount of money in the system goes down, you're still required to make your repayments, And that's in some sense the other reason for a credit crisis is with monetary transaction occurs. So this is, where we are. I'm very hopeful that the cryptocurrencies will one day be able to address this problem. And it's very interesting to see them in some ways evolving in similar directions to banking in terms of sharding and taking up this transfer between different pools of cryptocurrencies using tokens like as basically as the Litecoin network is trying to do. Whether or not that's the right way to walk and whether we can actually find better solutions by looking at it in some other way, we don't know yet, but it's certainly something that we need to look at. Thank you.
Thanks very much. Okay, we have time for a couple questions. Mics are up here, so just please come down if you have a question. I will kick things off. Can you hear me?
Yep, I can hear you fine, thanks.
Great. So in Bitcoin, or in cryptocurrencies more generally, the closest thing we see to something that looks like fractional reserve banking is how some of the exchanges operate. And this isn't really something that's that they publicize, but is a kind of an area of risk that a number of individuals in the community are concerned about. I wonder if you can maybe comment on how you think that might evolve.
Well, worse than that. The last time I checked, there were at least 4 companies out there offering loans in Bitcoin. And as far as I could tell, they were all doing fractional reserve lending. And obviously, I think several of the exchanges have been flat out caught lending more money than they actually have. Fractional reserve lending is an emergent system, and it got the way it did because a number of very logical steps were taken from checking to making the loans in the first place, which is something the Goldsmith bankers originated. And it's hard to see, apart from regulation, what would stop Bitcoin just going in the same direction. I mean, there's nothing stopping anybody turning Bitcoin into a fractional reserve Bitcoin network. And then it would have basically all the same problems that the existing banking network has, because, as I said, this tying money and lending together, I mean, it's not that anybody ever designed this, but it was a mistake. And if it was put up as a solution in any distributed computing class, I think it would probably fail. It does not have, as a critical system, which monetary systems clearly are, it simply doesn't have the fault tolerance that it needs.
Yeah, thank you so much for the talk. My name is Ingolf Pernice. I'm from Weizmann Institute. I understand very much that it would be a desirable goal to separate lending from creating money. However, we had this in historical banking as well. We tried stuff like that, so commodity banking, for example. However, we always had this problem of matching demand and supply, and credit money seems to be the very best approach to do that, because you adjust the money that is needed directly, decentral actually, at the banks. So have you any idea what we could learn from historical banking and central banking, what we could integrate to cryptocurrencies which would have similar characteristics? Thank you.
Yeah, that's a very good question. I didn't cover it in the talk, but it's more accurate to think about the banking system as providing a monetary field rather than a monetary supply. And each bank at some level is adjusting its local money supply. And this is actually one of the other problems with the system, but never mind. Which is good if you want to start up an industry somewhere randomly geographically, you stick a bank in there, it creates money, people take out the loans to build the factories and so on, and this is actually, very desirable growth property. It's not that you can't solve these problems and find different ways to do things. That's distributed computing has a lot of different solutions in its pockets. I don't, the issue partly is how well different solutions will be understood and usable by the general public. One interesting idea which we've had here, but we haven't had a chance to really explore, is could you basically have different monies for different purposes? That would allow protection to be built into the system in terms of certain types of money are better protected than more riskier activities. And then you could try to have some kind of market-based solution that would allow transfers between the different monies. That's something cryptocurrency would lend itself to quite well. In some sense, you could also argue as cryptocurrency is actually doing it because there's so many different cryptocurrencies at the moment. Other solutions, it's good to appreciate with the central banks that they don't really have the control of the system that they're actually accused of having. This becomes more evident if you get to sit on high-level councils, I guess. But the central bank really is just another bank. And all it can really do is sit there guaranteeing being the lender of last resort and messing around with interest rates when it feels like it, which doesn't necessarily help very much. Somebody can just start up a bank, expand the money supply locally to their regulatory limit. And the central bank doesn't have a whole lot of control over that until after the fact when problems start emerging. So I wouldn't regard the current system that we have as being well controlled. It's a very slow system. That's why we tend to think, it isn't, perhaps it's better regulated than it really is. It's somewhat glacial. I mean, it's got a time period of about 20 to 30 years. But actually under detailed control, I mean, that in some sense goes against its very nature. It's a distributed mesh-based system. The whole point of those systems is that they don't have central points of control because that would be a single point of failure.
Okay, thank you so much. Let's bring up our next speaker.